July saw a change of political power in the UK, but despite all the noise in the lead-up to the general election, financial markets did not react significantly, given that a Labour victory had already been priced in. Overall, it was a relatively volatile month, as growth and defensive assets grappled with some key political and also economic news. Commodities were weaker, driven by oil prices, as the market assessed the impact of lower demand from China, countering the supply issues arising from continued hostilities in the Middle East. Starting with the US economic news, weaker labour market and consumer price index data reassured defensive asset investors that the Federal Reserve is likely to reduce interest rates in the next few months, and this will start a downward trajectory of rates into 2025. The UK saw stronger than expected economic growth for the second quarter, and healthy service sector PMIs in July helped the overall economic picture. In Europe, the news was less positive due to the uncertainties around the French election and also disappointing purchasing managers' index figures over the month. As August started, the Bank of England reduced interest rates from 5.25% to 5%, the first drop since the onset of the COVID pandemic in March 2020. The Bank of England's rate-setting committee voted by a majority of 5-4 to reduce the rate. However, this was widely anticipated by financial markets. Turning to US growth assets, after helping to drive equity markets so far this year, it was growth stocks that were particularly weak, as investors grew more cynical about the expected returns from artificial intelligence. This was not helped by 4 of the Magnificent 7 technology stocks reporting results that disappointed some investors. With over 50% of major US companies having reported, one of our key messages at the start of this year appears to be playing out. A broadening of earnings returned is being seen, as over 2/3 of these reported major US companies have beaten analyst expectations. UK and European growth assets performed in line with their differing economic pictures, whilst Japanese equities were held back by the yen appreciating against the dollar on the back of recent Bank of Japan rate hikes and the prospects of lower rates in the US. Look at the performance of factors. Unsurprisingly, the news on growth stocks impacted the growth factor. Interestingly, the expectation of a near-term cut in rates from major central banks saw more positive sentiment to the small cap factor. Looking at defensive assets, the UK 10-year gilt yield dropped sharply towards the end of the month, ahead of the expected decline in interest rates on the 1st of August. And this action was mirrored in the respective US yield also. Turning to credit markets, investment-grade bonds outperformed their high-yield counterparts. So in summary, July was a volatile month for financial markets. Weaker inflation, labour market data from the US intensified expectations of rate cuts, but there is a near-term risk that bond markets may have moved too quickly. However, the broadening of earnings returns in the US was welcome news, and the overall message continues to be the same. Maintain a broadly diversified portfolio of assets as this market volatility continues.